This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We know that investors' attitude to risks differ. Different investors have got different risk attitudes, different feelings of what sort of risk is worth undertaking. Some people are adventurous, some people are more cautious. And ideally, the attitude of the investors and the attitude of management should be congruent. They should look on risks or uncertainties in the same ways. If management has an attitude to risk which is much more adventurous than that of the shareholders of the company, then of course directors, the board, management are not really running the company in the way that the shareholders would like. And it is ultimately the director's responsibility to act in the best interests of the shareholders. And who determines the best interests of the shareholders? Well, that's going to be the shareholders. High risk, low risk, not one right, not one wrong. It's a preference which they're entitled to have. Now, of course, the attitude to risk will lead on to differences in how decisions are made. And we have a simple example here of how decisions could be made under conditions of what's known as risk and uncertainty. The difference between those two terms is that if you are making decisions under conditions of risk, then you know or are willing to ascribe probabilities to each outcome. So here we have what's called a payoff matrix, which is a simple table showing what profit is 1600, 1400, etc., etc. These are all the different profits that can arise, depending whether there's a recession, the economy is stable, or there's going to be growth. And we have put probabilities here that there's 0.3 chance of recession, 0.5 that the economy is going to be stable, and 0.2 there's going to be growth. And management is faced with three possible strategies, having different outcomes, different profits, depending on how the economy turns out. So for C, if there's a recession, then the strategy C will only give you 500. If there's recession and you've chosen strategy A, it's going to be 1600. So if you have got the probabilities, you have much more information. You can begin to take the probabilities into account. You can weight the outcomes of the probabilities. And the standard way of dealing with this is what's called expected values. And expected values is simply the probability times the outcome multiplied together and added up. So expected value here, if you went for strategy A, there's a 0.3 chance that you make 1600. There's a 0.5 chance that you'd make 1400. And a 0.2 chance that you get 1350. So you simply work all of that out, and so that I don't bore you by working it out in front of you, I've done it before, and it's 1450. We don't think we're ever going to make 1450. The expected value is usually not a figure we expect, despite the name. We're going to make 1600, 1400 or 1300, 1350 as far as we can see. But this is a figure which tries to bring together the outcomes and their probabilities. Similarly, the expected value of B is going to be 0.3 times 1300, etc., 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 all the way through to 0.2 times 1500, and that came to 1440. And the expected value of C is going to be 0.3 times 500, all the way through to 0.2 times 2000, 1100. Again, it's a way simply of trying to weight the outcomes of the probabilities. The highly likely outcomes are given more importance than the outcomes which are unexpected or not really expected to occur with much probability. And management would look at this and say, well, of these three, the best one is 1450. All things being considered, we'll therefore go for strategy A, as that produces the best, highest expected profit. This approach is often said to be a risk-neutral approach. You're taking the risk into account, but you're taking it into account in a very kind of objective way. You're using the probabilities, 0.3, 0.5, 0.2, in a mathematical way. There's not much subjectivity comes into it. It's risk neutral as an approach. However, we were very lucky in that situation. We did have these probabilities. And if you think, trying to forecast the probabilities for how the economy is going to be doing, it's pretty tricky, isn't it? All sorts of unusual events occur, which can suddenly mean that where you were perhaps pretty sure the economy is going to be stable, it really turns into a recession. And sometimes people say, I've no way of trying to forecast the outcomes with any probability that I put any value on whatsoever. I've no way of putting a figure on the likelihood of the outcome or anything that I want to do mathematics with. So if we were to eliminate the probabilities, then we're dealing with making decisions under uncertainty. And in that situation, we come in to make decisions which is much more based on our subjective opinions, our subjective attitude to risk. Some of us will embrace risk seekers. Some of us are frightened of risk, want to avoid risk and so on. It's not right, it's not wrong, it's something we are, it's a result of our how we're born, how we're brought up and so on. We have these different attitudes. And the attitude of the decision maker is going to inevitably spill over into the decisions made. And to give two examples. First of all, there is an approach which is called maxi-max. Maxi-max is an approach which is taken by a real optimist, a very probably bouncy person, always looking on the bright side of life and so on. No matter what's going to happen, this person believes that he or she are going to land on their feet, come up smelling of roses, whatever other saying you want to put to it. So this person will say, right, if I were to go for strategy A, best thing that's going to happen there is I'm going to make 1600. If I were to choose strategy B, then the best thing that can and therefore will happen is I will make 1500. And if I go for strategy C, I am absolutely sure that's what's going to happen is I'm going to make 2000. So we have the best, 1600, 1500, 2000, and the best of the best, the max, the best of the best, is 2,000. And this person will say, therefore, I will go for strategy C because it offers me the best possible return that could come out. And this person will ignore the possibility that you could in fact also be opening up the doors to the worst possible outcome that could come out. That also happens with strategy C. But the max person doesn't look at that downside, looks only at the upside, and will therefore choose strategy C as giving the best of the best. So still ignoring probabilities. The next person, or the next approach, is known as maxi-min. Think of the min. This person is more of a pessimist. This person will say, whatever I choose, I want to stay away from bad results. So say, well, let's see what the bad results are in each strategy. And they're kind of fixated by the downside. They're a pessimist. So this person says, if I go for strategy A, the bad thing that's going to happen to me is 1350. If I go for strategy B, the bad thing that can happen and will happen probably, we don't know probably, but you just feel it, is 1300. And if we go for strategy C, oh my goodness, look how bad that is. I could go for strategy C and only make 500. So these are the bad things. And then it says, well, what is the least hurtful? What is the best of the bad things that could happen? And that is 1350. That's a better profit than 1300 and 500. And this person will therefore go for strategy A. So our max person went for strategy C, seeing the 2000. Our maxi-min person went for strategy A, saying, well, this is going to give me the best of the bad things that can happen. This is going to be the best way of insulating me from really bad results. Playing safe, if you like, we're going to go for strategy A. We cannot say that strategy A is right and strategy B is wrong, or the other way around. They're just different outlooks, different kind of decision that the decision maker feels comfortable with. And this is decision making not based on rationale particularly, it's based on emotion, on feeling, on attitude to risk. Finally, on risk and uncertainty, it's worth, I think, just mentioning some of the shortcomings of expected value. Expected value, in many ways, seems the most satisfactory result because we're using more information, we're using the probabilities, but expected value has got some drawbacks. So here we have two possible projects we could go into. We could adopt project A or project B. And the projects could be opening in a different country, it could be launching different products. Project is a very general name, essentially it's different decisions that we're making. We've got two states of the world. Maybe state of the world 1 is where the economy is poor, state of the world 2 is where the economy is good. Or state of the world 1 is where there's a lot of unrest around the world. State of the world 2 is where there's more kind of peace and prosperity and so on. And someone has assigned probabilities to these different outcomes of 0.6 and 0.4. So project A will give us 2,000 or 10,000. Project B will give us 4,000 or 6,500. And the expected values calculations would say for project A, there's a 0.6 chance of making 2,000, that will be 1,200. Or there's a 0.4 chance of making 10,000, that's going to be 4,000. So the expected value of project A is 5,200. Similarly, in project B, there's a 0.6 chance of making 4,000. So 0.6 times 4, 2,400. And a 0.4 chance of making 6,500, 2,600. And pure, rather naive expected values would say you should choose the project which gives you the higher expected value. So it would be pointing here towards project A. 5,200 beats 5,000. What might be wrong with that conclusion? And there are a number of potential reasons. First of all, how are the probabilities acquired? If you change the probabilities very slightly, you can change which of the projects you would prefer. Hard enough, I would suggest, coming out with the amounts of money involved, but how do we know it shouldn't be 0.5 and 0.5 rather than 0.6 and 0.4, or indeed 0.75 and 0.25? It must be really open to question how these probabilities have been arrived at. Secondly, there is a name expected value. If these are once-off projects, if you do project A once, we are saying you'll either get 2,000 or 10,000. We are not ever expecting you're going to get 5,200. Similarly, if you do project B, we are saying either we will get 4,600. We are not expecting 5,000. So usually, actually, the phrase expected value we better call the unexpected value. Now that's for once-off projects. If you're repeating the experiment many times, like it's monthly sales, weekly sales, daily sales, then the expected value will settle down to be the average. But on a once-off project, for project A, we're either going to get that or that. If we actually expected 5,200, it should be in these outcomes somewhere. So here we're making decisions based on two figures which are not actually expected. So there must be some doubt over the quality of the decisions we're making. Third point is really to do with risk. What I haven't told you here is that the project cost was 3,500. This means that if the project cost 3,500, we see no possibility whatsoever of making a loss if we adopt project B. The worst outcome is 4,000. The thing has cost 3,500. We're bound to make 3,500 at least. However, with project A, we could invest 3,500 and only get 2,000. There's a loss going on there of 1,500, which could actually be fatal to the company. So here we have really the project with a higher expected value. Has also got a higher risk, a higher range there, 2,000 up to 10,000. It's a very large range of outcomes, and the lower one's very serious. Whereas here, there's even though the overall outcome is maybe not quite so attractive, but there's a very limited, very narrow range of outcomes, and therefore there's much less risk associated with it. So expected value of itself does not take risk into account. And really, it is impossible to make any sort of decision on what you're going to do, what the company should do, based on returns without taking risk into account. Other methods that we can use to try and assess or deal with risk and uncertainty. First of all, there is sensitivity analysis. And sensitivity analysis is usually described as a percentage by which one of your assumptions must change before you get to a break-even or a zero net present value. And generally speaking, the smaller this percentage, then what you want to do is to try and get some more information. So if you could vary one of your assumptions by only 2%, then of course you know that's a really kind of sensitive assumption, and we would really like to try and find out some more information to see how likely that 2% fall is. Remember that there is not really a particular connection between the percentage fall in an assumption and the probability of it happening. So I could suggest that a 2% fall in the volume of products being sold is highly likely, because the volume of products being sold can be quite difficult to predict. But a 10% increase in maybe the cost of the project, or a 20% or 25% increase in the cost of the project, is actually relatively unlikely to occur, because it's probably easier to establish control over costs than it is over future sales volumes. The second method is scenario planning. And scenario planning looks at a set of events that are likely to occur. So, for example, if you had an election coming up, we could have Party A or Party B getting in. And Party A might say increase interest rates. Maybe we think up by 2%. Maybe Party B we think might reduce interest rates down by 1%. And then we think at the same time, maybe we have government spending. Maybe we think this is maybe potentially going to go down here by 5%. Maybe this one here will go up by maybe 6%. Now, in a way, what we've got here are potentially a number of different permutations, 4 different permutations. In some ways, interest rate could be 2%, government spending could be 5 or 6, so that's 2 permutations. Or interest rate could be 1%. The government spending could be 5 or 6%. That's again another 2 permutations. So 4 permutations are going on there, but actually only 2 are likely. So the set of events which are likely to occur are these. Because what happens when you're looking at future outcomes, you can say, well, maybe the exchange rate will do this, maybe interest rates will do that, maybe other factors in the economy will do something else. And you can end up with huge different number of permutations. And what we need to do is simplify that and say, out of these maybe 16, 32 permutations, let's get a few viable sets of permutations which it's worth actually looking for as potential outcomes. So we've been dealing with risk and uncertainty, but now we need to, in a way, drill down slightly to see if we can answer the question, what is the appropriate amount of risk for an organisation to undertake? And this comes down to something called risk appetite. And the risk appetite is the nature and strength of risk that the organisation is willing to bear. And it has 2 components. First of all, there is the risk attitude. And that essentially is I will start with the word directors in here. Essentially, this is the director's view of the level of risk they think is desirable. And this depends on one's own attitude to risk. Some people are fond of higher risk situations. Other people like to play safe. So the first component is really your attitude to risk. Are you essentially a risk-taking person or a more cautious person? Which end of the range, if you like, do you feel comfortable at? The second component of risk appetite is the risk capacity, which is basically how much could you afford to lose, or how much can an organisation bear. And both of these components come together to produce the risk appetite. Now let's just deal with directors first, and we'll get on to other stakeholders later. And we can start really with a kind of personal example. Let's say you were betting on a race, and one horse is there at kind of favourite, so it's 2-1 on. Another one is there with very long odds, 1-100. Now some people would be slightly more attracted maybe to going for the long odds, the 1-100. They like that element of risk and gambling. Others don't like the gamble. They would rather put money on the favourite, the 2-1 odds, on odds favourite. Now if you had $100 in the bank, I beg pardon, if you had $100,000 in the bank and were thinking of putting on a bet of only $100, so you have 100,000, you're betting 100, there's a good chance that even the very risk-averse person would be, almost for fun, for the sake of it, put $100 on the horse, which was 1-100 odds. Because actually losing $100 when you have a fortune of $100,000 isn't going to make much difference. So in other words, you can afford to lose 100. You can bear to lose 100 without really kind of worrying about it. If, however, you had $100,000 in the bank and were thinking of maybe betting 50,000, then of course the risk-averse person would never dream of wagering 50,000 on a horse with 1-100 odds. If their entire wealth was 100,000, they'd be standing to lose too much. They perhaps couldn't afford to lose that. They've got other commitments. Whereas if you say, well, actually the odds are 2-1 on, then although betting 50% of your wealth is still a lot, you can see that this becomes something which is more attractive, perhaps, to both parties, but in particular more attractive to the risk-averse person. So the two have to be taken together. What are you prepared to lose? And really, how comfortable do you feel with losing that? How comfortable do you feel with the actual kind of probabilities of losing that? Now, the directors should be acting in particular, for the shareholders. It's really their statutory job to act in the shareholders' best interests. And we have a particular potential conflict coming in here. What happens if you have directors who are liking high risk and who maybe don't have much to lose because they're going to get their salary, their bonuses and so on, and you have shareholders who perhaps don't like high risk and may be losing their entire investment if the director's decision is wrong. So there's this potential conflict here between the directors and the shareholders. And this is, of course, is something which corporate governance tries to address, but trying to keep a better eye on what the directors are doing by having non-executive directors and so on the board who try to be neutral almost, or with respect to any rewards they might be getting, and should be warning the directors and advising the directors and so on that they may not be acting in the best interest of the shareholders. Now, in fact, you can widen shareholders to other stakeholders. Directors might be thinking of an investment which might cause the company to fail. And of course, it's quite legitimate for employees to have some fear, perhaps, about that decision of the directors. So when directors are making decisions, they should be thinking what's good for all the stakeholders, generally what in particular is good for the shareholders, and they have to try to almost imagine what the risk appetite of their shareholders would be. What risks are my shareholders comfortable with? What amounts are my shareholders willing to lose? What are they comfortable with? And the directors should act in the shareholders and indeed wider stakeholders' best interests.